President Bola Tinubu has signed an executive order aimed at cutting costs and boosting investment in Nigeria's oil and gas industry. Here's what you need to know, especially about the new tax credit system. A tax credit is a direct reduction in the amount of tax a company owes to the government. It's not a refund of money, not a deduction from profit neither. It's a reduction in the actual tax bill. For example, if a company is supposed to pay 1 billion naira in taxes and they have a 200 million naira tax credit, they'll only pay 800 million naira. The new cost efficiency tax credit rewards upstream oil companies that reduce their production cost below a benchmark set by the government. So let's say the government, that is the National Upstream Petroleum Regulation Commission, sets a cost benchmark every year, for example, $30 per barrel for offshore drilling, and a company produces oil cheaper than, say, $25 per barrel. It means the government can tax a bigger profit. The extra tax revenue that the government gains because of its lower cost is calculated. The company is rewarded with a tax credit worth 50% of that extra revenue. No matter how much you save, the maximum tax credit you can get is 20% of your total tax bill. So if your tax bill is 10 billion naira, you can't get more than 2 billion naira in tax credits, even if your cost savings were massive. This is a smart move because it rewards efficiency without giving out free money. The government still earns because they spill the gain with the oil company. Operators have an incentive to manage costs better. This is especially important in Nigeria, where some companies are still spending over $40 to $50 per barrel. Something to look out for is, how will the benchmark be set? Will it be fair and transparent? Will companies try to game the numbers? Can regulators audit costs effectively?